macros then, we have Radhika Rao, I beg your pardon, Radhika Rao, who's a senior economist, executive director at DBS Bank, joining us this morning. A very good morning to you, Radhika. Thank you so much for joining us on ET Now. And I'm sure today everyone is only going to ask you about one big question, is the fact that how should one read into this big meeting between the United States President and Indian Prime Minister, given the fact that what sort of an impact it could have on India's economics?
Thank you so much for having me. Happy to be here. Certainly, I think the big point of conversation has been, in fact, just not overnight, but since early January, is where the US trade and tariff policies are going to be headed, and what does it mean for each of the countries, right? And I think the initial, I would say, 1 week to 10 days, where there weren't any material changes or executive orders directed at trading partners, kind of lulled the markets into some sense of complacency. That this might probably be more a negotiating tactic, and that they would not take too much of action. That followed with Canada and Mexico, and a 1 month delay there. We would be a bit more guarded. I think if you take the baseline of Trump, the first term of President Trump, the action usually starts slow. There's a lot of study going on, but eventually they do, put tariffs in place. So I don't think there is much room for complacency from that point of view. And coming back to, so if you see, what has happened until now, there's been a uniform 10% increase on purchases from China for now. And what we were expecting more recently is this thing about reciprocal tariffs and details thereof. Again, this is not something new. In fact, even if you had seen a couple of weeks back, there was already this announcement that USTR with the Treasury and the Commerce Ministry, I think, is going to come up in the US with this list of a deeper study, which are the countries with which US trades, and they would like to correct that imbalance. That was already due on April 1st, so I would think that this is just an extension of that announcement. So I do think this space should be watched very closely, especially for countries which are very export-oriented and have seen an increase in their own market share in US imports.
All right. Hi, Radhika. This is Shrishti also joining in. But Radhika, for today, we have seen the big announcements from PM and Donald Trump meeting. But other than that, Radhika, help us with your take on the overall scenario in terms that now that reciprocal tariffs have been announced, there could be some more to come. But given that the countries are now talking to double the kind of trade that they have with each of them by FY30, do you believe that more tariffs could be in place, and any sectors where you flag off which has the possibility of the implications coming in?
Yeah, sure. Let's set the backdrop for what we are discussing here. Compared to 2015 or 2016 to present, US's own total trade deficit has gone up almost by 50-60%, right? Let me talk about India. India's trade deficit or trade surplus with US and US's trade deficit with India has almost doubled. So again, if you compare between 2015 and 2024. So this is the backdrop that we're discussing against, that almost in all countries, barring China perhaps, you have seen either trade deficits widen or remain the same, with very few exceptions. So against this backdrop and from where the US is coming from, I think that is going to be the starting point, which is to get back to the trading partners because of the deficits that they're running. Compared to, again, the first term, I think the other important bit is that it's not just one or two countries with which US is trying to level its trading, level its playing field. Back then, it was China, a bit of their own trading partners in the neighborhood, especially Canada and Mexico. This time around, I think thanks to the supply chain realignments that have happened, I think the US have also recognized that there are a lot more countries that could be targeted. The other second takeaway for us is that what started off by retaliation has now become reciprocal, to mean that it's not that you bump it up by 25%, I bump it up by 35%, and it goes on and on, right? This is more about if there's a product class where, say, a country imposes 30-35% tariff, that US would also try and match that. So in some sense, again, level the playing field. And as an add-on here, now it looks like it's not going to be uniform, not uniform 25%, uniform 60%, more how much you do to me, I do to you, and on certain product categories. So these are the finer nuances, I think, which is again different from what happened back in the first term and now. I do think that many of the countries which have seen larger participation in terms of trade and investments from China in the past, say about 7-8 years, are likely to be very much in the view. Insofar as India is concerned, I mean, India's main purchases or main exports to the US, say the top 2-3 product groups are pharma. You've seen pearls and semi-precious stones, and you also see mineral products, right? So these are some of the main key things that India sells to the US. And basis the negotiation that has gone overnight, it does look like India would go ahead and purchase a lot more. And I think one of the relatively lower hanging fruits is energy imports, because India does rely on energy imports for almost 80% of its requirements. Right now, the source countries are Russia, followed by Gulf, and thereafter US follows. I would think the share of US might go up over the next 4 to 5 years. Certainly, that will be a place to start, and thereafter see places like defense, places like pharma, where else there could be agreements reached.
All right, that's very interesting to note, Radhika. But Radhika, I'm just going off the topic right here because just before you, we had Vikas from CLSA, and he was talking about the differential in the yields of India as per as US. And what is not making the FIIs rather look back to the Indian markets, and he believes that the differential has to come in place. For the Indian bond markets, Radhika, given that we are now experiencing a rate cut cycle, there could be more in place. What's your sense that where our Indian bond yields are expected to move from these levels?
Certainly, and we have a two-way move here. In the US, rate cuts have been undertaken, and this year the Fed is a lot more cautious. And you've seen a bit of an adjustment in the 10-year rates in the US, especially after Treasury Secretary came out to say that he would be focused on the 10-year yield, because again, in terms of borrowings, in terms of especially even for mortgages, that's taken as a guidance level. In India's case, the RBI has just started to cut rates, but you've already seen quite a notable correction in the bond yields. And from our point of view, we do think that again, RBI, and we are seeing that in the region as well, that most of the central banks are preferring to be opportunistic. They don't have a pre-planned rate cut schedule. I think they're looking for pockets where volatility is low, the currency is not under pressure, and markets are generally a bit of a risk-on sentiment. They're taking those pockets to act on rates and also support their own growth. And I think RBI is going to be in a similar boat. They have undertaken rate cuts in February. That was along what we had expected. We do think that April is going to be the other timeline where they could consider a rate cut. And we look for one more beyond that. And that could come perhaps in June as well, again, subject to global conditions. So 75 basis points of cuts in this cycle. Given where the fiscal consolidation plans are, borrowing schedule is not going to be a problem for the bond markets. We are looking for the 10-year yield to be closer to about 6.5, 6.55 by end of this year. I mean, when I say year, I mean calendar year. So certainly a bit more downside still in the play for the 10-year.
Of that, Radhika, I wanted to just understand what sort of a GDP growth are you penciling in? And also, lastly, I just wanted to check with you on the currency, given the fact that now we've actually seen, and there are reports indicating that there has been intervention by the RBI, and that's one of the reasons why, where we were very close to touching the 88 to the dollar mark, now we are hovering around or sub the 87 to the dollar mark. So what's your analysis of the currency market? And lastly, what you're penciling in for the GDP growth?
So let me start with the GDP growth first. We are going to have the GDP numbers for the third quarter, end of this, so like third quarter fiscal year by end of this month. You're going to also see some backward revisions in the data for the previous years. So we'll have to see how that works. I mean, if you just ask about the third quarter numbers, we are closer to about 6.2 to 6.4 for the third quarter. For the entire year, we're a bit more conservative than market expectations as well as the central bank. Our forecast is at 6.3. for the year. That's fiscal 25. So GDP numbers again showing us that momentum has slowed. There was idiosyncratic factors in second quarter which took growth to much slower levels. We think some of that will even out, and the monsoon in general had been good in the middle of last year. So in all, we are looking for a 6.3% growth for fiscal 25. Coming to your question on the currency, what you have seen is in fact a change in the dynamics have shifted insofar as the currency is concerned. Past 7-8 years, we have seen about 3 phases of how these intervention strategy dynamics have shifted, and where we are currently is that it is becoming, I think, thanks to global drivers, it's become quite expensive, to keep currencies at certain levels and keep volatility low. You have to intervene much more. That has implications on liquidity, and so on and so forth. So it distorts, quite a few other related markets as well. So starting off this week, I think what you had seen from the central bank is that they put quite a strong intervention response, and that was because rupee has kind of torn away from where the regionals are. Even when the regionals were stabilizing, there was a one-way move up in the dollar rupee, which I'm sure in their minds felt a bit outsized, and that's why they had to intervene quite aggressively on Monday as well as Tuesday, allow the currency to stabilize at much more meaningful levels vis-a-vis where the other regional pairs are. And I think that has played out. Of course, if you don't intervene too aggressively, you again seeing the dollar rupee, in the sub 87 kind of levels. Looking ahead and putting in, of course, our own dollar view, where our FX strategist, in fact, expects the dollar to continue to gain this quarter and the next. We have forecast for the dollar rupee also edging higher from current levels and breaking into the 88 level, handle in this timeline, and staying there towards the end of the year as well. So we do look for further rupee depreciation in line with what our view of the dollar, and intermittently you will see the central bank act if the dollar move seems a bit too much vis-a-vis where the other macros are. Otherwise, I think it's going to be more of a smoothing action to try and make up, a bit of the competitive advantage or other competitive disadvantage that rupee has versus its trading partners. I mean, typically you would look at the rear function for that.
Right, point taken. Thank you so much, Radhika, that you could make time this morning to join us on the show to talk about what exactly happening in the global scenario, what it means for India's economics, as well as giving an outlook on the currency market. Thank you so much once again for being part of the show.